Hello, good afternoon. So, as I told you last week, we tried to do an experiment about how to understand the price change, and I tried to ask you to buy. Oh, this doesn't work. Good. Okay, I asked you to buy 10 stocks. Now this, it can be watch list, not to buy for true, but just for an experiment, or you can put it in a paper, or you put it in your chart, wherever. It's just 10 stocks. Now these 10 stocks, for example, XYZ, XZ, RD, MS. Okay, just the stocks 10. Okay, from 1 to 10. Now what you do, you put the price that you buy the stock, for example, at the end of the day or something. For example, you buy here by, just an example, I will give you just two stocks here, and then you do the math later, because it's worthless to write all these. So for example, stock number 1, XYZ, is $10.50. Okay? 2, ZM, just an example, so these are just virtual, is 20.80. Okay? So this is the price, this is the symbol. You buy 10, like these stocks. Now, when I say you should diversify, it means you don't buy with the same sector. You should have different sector. For example, this is like a pharmacy stock or drug stock, pharmacy. The other one, you can go to retail. Okay? And you see the others. You can say banking, insurance, wherever, mining, wherever sector you want. So they should be all different from each other. Okay. This is what we call diversification. You don't buy from the same sector. Now, these 10 stocks you buy here, for example, last week, Monday. And you go to Friday. So here you buy, here you sell. Just an example. Suppose that this 10 goes to 12.50 and this 19.80. Okay? This is going up, this is going down. Okay? So, why we are doing this experiment? We are doing this experiment to show you that no one knows that this stock will go to 12, and no one knows that this 20.80 cents, it will go down. This is the market. This is what we call the future. So, no one knows what will happen in the week. Okay? So this is the future. Here is the future. When you are on Monday, you will never know what will happen until Friday for the stocks. Okay? That's why this is the basic idea for trading and investing. Okay, we begin with trading. So, we begin with trading first. If these two, you put a stop loss, as an example, here is 10.50, you put a stop loss with 9.50. You say, if the stock goes down from 10.50 to 9.50, which is $1, which is 10% or something, I will sell the stock. Now, since your stock is going up, you are making money. So, you are still in the stock itself. Now here, if you say, if the stock goes to 1980, just an example, it's not the same, I will sell. Now, for you, you bought 2 stocks for 1 week. You lost here $1, 20.80 to 19.80. You lost $1 here. But here, you gain $2. Okay? So for you, what is it for you? For your portfolio. Are you good or bad? Okay? For you, you are good. You are good. Why? Because you have +1. Because here you gain 2, here you -1. You are good. If you bought, for example, let's say 100 shares, 100 shares, 100 shares. So here you are gaining $100 for your account, for your portfolio. Okay. Now this is for trading. Now suppose that you are doing investing. Okay. Suppose that you are doing investing. Investing is different from trading in the portfolio, because investing needs time. This is the most important thing. You need time to see your stocks if they do good or bad. So most of the time you need at least 1 year. Okay, this is investing. Now you do the same. But instead of selling in 1 week, you sell here in 1 year. 1 year. Okay? This is investing. You sell in 1 year. Now we change the price. Okay? It's the same thing. Now you buy 10.50 and then it is 20.50. Just an example. And this is 18.80. Okay? So after 1 year, this 10.50 becomes 20.50. So you gain $1,000. Okay? It's $2. $2 by 100. No, it's $2,000. Okay? You gain $2,000 in the first one. Now, second one, 20 to 18, you lose $200. Okay? So you will have, in your account, you will have $1,800 as profit. Okay? So, whatever strategy you do, it's not important the strategy at all, because no one knows the future. A stock that you think 10 will never go to 11 or 12, it goes to 20 in 1 year. You don't know. Or 30 or 40, you don't know, because it is unlimited. Now for the downside, if it is 20.80 and it goes to 18 or 15 or something, you don't know where it goes down. And maybe it goes down to 18, it goes up to 20, 22, 25 or 30. So you don't know. So you give the stocks a chance to grow. Okay, you need at least 1 year. Because 1 week, 2 weeks, a few days, this is not investing. This is trading. You trade, you just have a little time. Day trade, just few minutes, or half an hour, or 1 hour, or 2 hours, or 3 hours. So for investing, you should need time. And the most important thing is you need a good capital. You need money. You need money. That's why I always tell you that little money is always dangerous, because you can do a lot with little money. You should need a big money in order to do investing. Now, so I hope you understand this thing first about investing. So you buy stocks, you leave them, and then you eliminate those who are not good and you leave the others that are good. Okay. This is how to do a portfolio. A portfolio, you don't see one stock if it is good or bad. Okay? You should see the whole stocks, the whole stocks, 10 stocks. Okay? And you add the prices, add their prices, and then you divide by 10. Okay? Suppose, an example, you add this and this. For example, 3. Okay? So it's 31.30. This is all the stocks that you buy, and it goes to 38. Oh no, 39. Okay? So from 31.30, you make your own stock by portfolio. Your portfolio will be like this. For example, 31.30. It goes like this. And it goes here to 39.30. Now when you see like this, you will see that you have made a portfolio as a mutual fund. Okay? You make your own mutual fund. Okay? So what is it, mutual fund? It's just collection of stocks. You stay 1 year, the good you leave them, and the bad one you exit them. It means you just dump them and take them from your account and replace them by others. This is how the people do. All the people that you know that are very famous, they have mutual funds. They do their own, okay? Their own stocks. They choose their own stocks. Here, I'm not speaking about strategy. You do the strategy that you like. The only thing that it is important is that you diversify. You don't use in one sector, you use a lot of sectors. And you don't see one stock because you don't know the future. This stock goes down. If you know that it goes down, you will not buy it. Okay? But since you don't know the future, you buy it. And this one, if you know that it is from 10, it goes to 20, why you buy this one? So you put all your money here, and you will have not 1,800 like profit. You will have like 10,000 to 20,000, 20,000. And since we don't know the future, so we make our portfolio as a mutual fund. You try to make your own mutual fund, and you should wait 1 year. You don't sell very quick. And usually here, if you have 1 year, for the stop loss, it should be like 20% or 50%. Because the stock, when you buy it like 10, see here, 10.50. It can go to 8.50 in the year. And then from 8.50 goes to 20. Okay? So you leave the stock, do whatever. Okay? What is the most important thing is the last day. After 1 year. Okay. There is another thing very good about investing. It means more than one year, more than 1 year, more than 1 year, is about tax. Okay? Tax. When you sell after 1 year, your profit is taxed 15%. Only 15% if you hold the stocks for more than 1 year. But if you sell less than 1 year, you will pay an income tax. You will pay an income tax maybe like 25%. Okay? So tax is very, very important in investing and trading. All the people who trade, their profit is taxed more. So a lot of people who have big money, they don't want to trade, to go in the market, go outside, go in, go outside. So what they do, they buy a lot. For me, I told you to buy only 10. But for real investing, it means if you invest, you should have money to buy from 20 to 30 stocks. In different sectors, it means there is diversification. Okay? You diversify. You should buy from 20 to 30 stocks. That's why I told you that when you want to invest or trade, you should have money. Okay? If you don't have money, how can you invest? The only thing you invest when we have little money is like the people who have the 401k. They can invest the same by choosing mutual funds. They have limited choice, but they can do it. Now here, if you do it by your own, you can buy from 20 to 30, or you can buy by time. Okay, you buy, for example, 4 or 5 stocks, and then next month you buy 3, the other month you buy 2, like this. And you buy and you buy and you buy until you have 20 to 30 stocks. You can have more or you can have less, it depends on you. But the more you have, okay, the more you have, the more you minimize. You minimize the risk. Okay? Because if you tell me, for example, why I should buy a lot of stocks? Why should I buy only one stock? One stock for investing is very, very risky. Now, why it is risky, one stock? Because you buy a stock with $20, $50. In 1 year, it can go to $3. Okay? So, you lose all your capital in 1 year. But if you buy like mini stocks, one goes down, this 1050 it goes up, the other 9 it goes up, the 5 goes down, like this. And you think about the portfolio, the all mutual fund that you have, the overall. So your profit will be for all the stocks, not for one. Because if you select badly a stock and it goes down, so you will have 2. You tell me, for example, and if one stock goes up and I put all my money, I will ask you the question, how do you know that this stock will go up in 1 year? Okay? You don't have no answer because it's the future. No one knows. All the big guys who have too much money, mutual funds and hedge funds, all of them, they do the same. They buy a lot, different stocks, and they see which one goes up for 1 year and those will go down. Now those that go down, they eliminate them and the replacement by others. So you always have 20 or 30 stocks. Okay? I will put later. I will put like a table where I put the stocks that I bought. Now the stocks that I buy or you buy or the other, it's not important what is these stocks are, but just an example of a portfolio managed as a mutual fund. Okay, this is the ideal thing. Okay, and then you can see the profit or loss, in 1 year. We have spoken only about 1 week, just to be very short, just to know how the stocks go up and down, so you don't control anything about it. So you should leave it 1 year in order to understand investing in general. Okay? So please, if you have a question about this or about this experiment, and just ask questions, and I will put another video if someone asks me another question about this thing. There are many theories like this that help understand the portfolio. In the future, I will try to find like a portfolio management, and I will try to explain. So for now, just try to understand how the portfolio goes, profit and loss in 1 week. But for you, if you want to invest for the long run, more than 1 year, which is the best idea to do, is to buy more stocks and to wait for 1 year. And you don't see one day what will happen in 1 day. You don't see this. You see in 1 month or 2 months or 6 months, you don't worry about the stocks. Just you leave them. Okay? You have 20 or 30, just you leave them. Now at the end, after 1 year, you will try to check what the stocks are doing. Okay? There is a risk of loss and there is a loss of profit. But by this structure, by this strategy, you minimize the risk because we have a lot. Okay? Okay, thank you very much. If you have any questions, just ask.